Hello, everybody. Welcome back to my YouTube channel and welcome back to the podcast. Today, we have a very special guest. Dr. Adam Gower is joining us today. He is a real estate professional of over 30 years standing. He's based down in Los Angeles, and he has a huge background in commercial real estate with over $1.5 billion in commercial real estate investment and finance experience. Today, he builds digital marketing systems for real estate professionals who want to raise equity capital, and his clients handle in excess of $35 billion in assets under management and have raised hundreds of millions of dollars using his systems. He's taught about 5,000 individuals how to build wealth, preserve capital, and earn passive income from investing in real estate. And he himself has over $7 billion of experience transacting real estate with high net worth individuals, major institutions, and banks. Welcome, Adam. Nice to have you on board today.
Yeah, and all of that at my young age.
No, I can relate to that. And you're still doing it, man. You're still here,
I know,
So,
exactly right. I'm on the treadmill.
well, I'll tell you something. We are at a very interesting point, I think, in the real estate market right now. One of the things that I talk to people every day. I'm still a working realtor, and I've never seen. I don't have 30 years, but I've got over 25. And I've never seen more uncertainty in the market, both for commercial real estate and for residential real estate, both with the public in general, with realtors, with bankers, with lenders. I think even, and I'm up in Canada. I'm just outside of Toronto, so I'm up in Canada. And you're in LA, right?
Right.
But I think there are similarities, even though real estate markets are definitely local. There are some similarities. I think there's stuff going on around the world right now. So nobody seems to know where we're headed. I mean, we've been through some interesting times. We had zero to low interest rates for several years before the pandemic. Then we went through the pandemic, and there's been trends from that are still playing out. I think people working from home has done a big number on office buildings downtown. That's for sure, in any city. And so, give me your thoughts. Let's talk a little bit about where you think the market's headed. I think there's some changes afoot for sure, but nobody seems to be absolutely sure where we're headed.
Well,
Adam.
so it's a really interesting, Randy, it's a really interesting question. And to answer it, I'm just going to spin back in time briefly
Okay. Okay.
before looking forward. So what's happened in the market with the increase in interest rates is there's a few impacts on
Yes.
investor sentiment. First of all, stock values have gone down. So people are feeling like they have less wealth. Inflation has gone up, although that seems to be taming a little bit. But nevertheless, that's eroding the value of savings. And because of interest rates, we're also seeing a downward pressure on home prices. So people are feeling that their primary residence is not worth as much as it was yesterday, and are reluctant to move anyway, because to sell a property that you might have a sub 3% interest rate in, to move up something that's a 7% interest rate, creates severe market friction. So what we're seeing, and our work is primarily in commercial real estate investing, right? So what is colloquially called crowdfunding. What we're seeing is a slowdown in investor interest in the bull market type investments that they're seeing, where you have good where you've got sponsors, advertising, equity, good returns, equity multiples, or IRRs, or even preferred returns. That type of investing has become less appealing, and what investors are looking for more today are two things. One, protection of their investment. They want to be sure that what they're investing in has solid downside protection. And two, they're looking for opportunistic acquisitions. In other words, deals where values have come down and there's an opportunity, what I call a wealth transfer opportunity, where somebody who underwrote a deal with too optimistic underwriting is now going to lose that deal, and there is an opportunity for a new investor to come in, or new investors to come in, to capitalize on that misjudgment. Now, your question was, where are we going? So So we talk to a lot of investors, individual investors, and also to a lot of sponsors. And the general consensus is that towards the end of this year, that's when we're going to see much of the opportunities emerge, much of the discounted, distressed investment opportunities emerge, particularly as loan maturities reach their walls. And that will spread out into the early part of next year. Now, so the first 2 quarters of next year. Now, there is something very interesting that's just recently been announced, and that is that regulators, the banking regulators in the US, have indicated to banks that they should be more favorable to loan extensions or loan accommodations for commercial real estate.
That is happening here too.
So what that is signaling is that the only reason that regulators would do that is if they believe that the down cycle is likely to be short. So what they're looking for is an extension of these loans to outrun any kind of downturn. And what I think that also suggests is an anticipated reversal of Fed policy and a reduction in interest rates after another couple of increases that we're likely to see before the end of the year. Because as soon as that happens, what you're going to see is an explosion or a return to the markets of equity capital, searching for opportunistic acquisitions before prices rise. And so that will in itself trigger a rise in values, and opportunistic investments will likely, I want to say pitter away.
Pitter patter.
Start going away. Yeah.
You know, what's interesting, that I think that's exactly happening here as well. Where the confusion comes in is now the Fed in the US has been very hawkish all along. They've said exactly they're out. They want to kill that inflation beast. They're raising interest rates. They want interest, I guess, down to 2% or whatever their target goal is, the core, so-called core inflation. And we have the Bank of Canada here, which is our Canadian equivalent of the Fed in the US. And I also happen to believe that all the central banks in England and Europe and Japan and all these places, Australia, they all coordinate. They don't act on their own. I think they know what they're doing. But the US has always been hawkish, so they kind of told the truth. The Bank of Canada, earlier this year, the governor of the Bank of Canada said, don't worry, we're not going to raise interest rates anymore this year. We believe it's plateaued, and we're looking forward to reducing rates by the end of 24. That was like just back in February. Then they went and increased rates anyways in June last month by a quarter point, and they have a meeting. The Bank of Canada has a meeting tomorrow on July the 12th, and everyone is expecting another quarter point increase. So what happened, though, this year is exactly what you're talking about. When people heard from the bank, the Bank of Canada, they thought, great, that's it. We're at the end of the tightening cycle. They're going to stay flat, or they could start going down by the end of the year. So people went out, they started buying assets. They started buying commercial properties. They started buying houses because the psychology changed. They figured, well, we're at it's not going to get any worse. We have to do this, or for a house, we have to live somewhere. And people went out, and the market really took off for about 3 months. It really did. Prices started going up again, just what you said. It triggered it. Then our Bank of Canada surprised everybody because, again, they're following the Fed's lead. The Fed raised rates a couple of times, and I'm sure they're coordinating this. They have to be. So they raised rates once in June, and now I believe they're going to do it again today. And meanwhile, the market has cratered again. Both for residential and commercial. I think it's a psychology where people are not sure. And when they're not sure, they don't want to take any big risks. And so that's where we're at up here. It's just because our Bank of Canada governor is a little flakier than your guy down with the Fed.
Yeah. So there
but I agree with you.
There is definitely uncertainty in the market. But what we do see is a strong interest from investors in what I called either opportunistic or distressed real estate opportunities. And that's really, it's the idea is that, the thought is that for the one step back that you might be taking, you can take two with the decline in values, especially if you're already active in the market,
Mm.
you can take 2 steps forwards with investing in a distressed deal. Now, what are you seeing in terms of, now your specialty is residential, right, Randy? So what are you
Yeah,
seeing with
primarily.
resi? Yeah.
Well,
And
again,
residential single family or multifamily?
both, both. The Toronto is it's a lot of high-rise condos here, a lot, sort of like Chicago in a way. There's a lot of high-rise living, and you can talk about multifamily too, although that kind of blurs the line between residential and commercial. But prices went down. They definitely went down about 20% since the rates started going up last year, and that's a big hit because prices.
20%, did you say?
Yeah,
Prices have
yeah.
come down
Now,
20%.
yeah, I'm talking in Toronto. There's the two big cities here are Toronto and Vancouver for real estate. Vancouver's out on the west coast, and we're sort of in the center. There's other cities as well, but yeah, and we have been on a tear up here in Canada. Prices. We never went through the big drop that you guys went through in 2008. There was a slowdown, but we didn't have a crash the way real estate crashed in the U.S. There's tons of immigration coming in here. They've actually just announced that there were record numbers of immigrants in 2022 and also in the first half of 2023, where Canada's population is just skyrocketing.
So, but you're seeing a 20% decline
They're
in
in
residential values
in single family homes,
in
and
single family.
that's in the city of Toronto. But again, real estate is so localized that there are parts in the heart of the city where that didn't happen. But in the suburbs where I'm located, yeah, it's about 20%.
And so, what is going on with the supply? Because one of the factors that is tempering the downturn in single
Yes,
family is this point I made originally, which was that there's people are unwilling to sell because to buy something else, you're looking at a significantly higher mortgage. So, supply is very, very limited. And that
yes.
is what's propping up values. Values are coming down. There's no doubt about that, but not
Adam,
precipitously as you might expect.
Adam, you are right on the money. Definitely, there is a shortage of supply. I'm not sure why. Immigration has part to do with it, but it's more than that. There's all sorts of problems in where I live and work with red tape, delays. It can take a developer in Toronto 5 years to get a building permit.
Mm-hmm.
5 years for a high rise downtown. And it's built up. It's a large city, and there's some protected areas which I'm okay with, or parkland and stuff that they should not be building on. But there's plenty of land. It's just there's it's like inertia and a lot of red tape. You're dealing with municipal governments. So you got the federal government that are letting in immigrants. You got the provincial government that are setting policy, like the state government, the provincial government that are setting policy on real estate, and then you got municipal governments that are all tied up in red tape. We got NIMBYs, the whole thing. So that's definitely part of the problem. And then you've got discrepancies within the country. It's a big country, much smaller population than the US, but there are areas of Canada that are very affordable still. So people are
And
moving out.
Do you see Canadian residents looking to invest in the US? What are you
Yes.
seeing?
Oh, yeah.
And what are they looking at?
Well, there's a wide range. I mean, you've got your typical snowbirds, we call them snowbirds, where they're older, over 50s, and they're financially secure. They go to Florida every winter and they want to buy either a condo or a house or a townhouse of some kind, do property management during the rest of the year when they're not there. So there's a big selection of that. But there's a lot of cash out there, a lot of cash, and it's all looking for a place to go. So you've got investors, heavy duty investors here in my area that are buying up multifamily properties in Nebraska or wherever, because that's, it's a thing now. And they see, in spite of the difference in the $2, they're seeing opportunities in the US right now that may not
And what
exist in
kind of
Canada.
yields can you get, cap rates do you see on multifamily in Canada?
Oh, you know what? Again, I'm not right. I can't give you up-to-date stuff on that because I'm not a commercial guy. I could look it up, but I can tell you from friends of mine who are heavy-duty investors right now, they're saying we're not buying here. It's not. The numbers don't make sense, so they're buying out in smaller cities in other areas. I
And
just don't want to give you a number that's wrong.
Yeah, that's fine. Do you see any distress in Canada?
No. Well, there's a number of things going on. Again, with the increase in mortgage rates over the past 15 months or 18 months, we have a slightly different financial system here than the U.S. In the U.S., when you on residential, when you buy a house, you typically take out a 30-year mortgage, correct? And that mortgage is fixed for 30 years. The rate, whatever you take it out at, is fixed for 30 years. In Canada, we have the 30-year amortization, so it's paid off over 30 years. But the mortgage requires a renewal, typically every 5 years. And you have to renew that interest rate every 5 years at whatever the current rates are. So the problem that a lot of consumers have today who took out a mortgage 5 years ago when mortgage rates were 2%, now they're having to renew at 5.5%, which are the current rates. So they're getting killed. They're getting killed. And the banks, to your point, what you mentioned earlier about how the banks are being kind of instructed to be friendly. The banks here, I believe, are just from anecdotal evidence. You're not going to read about it in the newspaper. But what they're doing is they are, for people who are in distress, having to go from 2% mortgage to 5.5%, they are extending the amortization out beyond 30 years to 40 to 50. I've heard even to 60-year amortization in order to keep the payments low. Now, in my book, if you're paying down a 60-year mortgage, that's renting, I think. You're just, all you're doing is paying interest, plus you get to pay taxes and insurance and utilities. But they're doing that quietly. I know that for a fact. Not multiple banks are doing that quietly just to keep people. They don't want foreclosures. They don't want that. So they're doing everything that they can for existing mortgage holders to stay in their house.
Are you seeing increase in single family supply, or because of these interest rate fluctuations, or not? Are people selling, or is there a dearth of supply?
That's the crystal ball. That's the $1 million question right there. Until the last month, we've had a shortage of supply. It's been at historically low levels. The number of MLS listings has been at 20-year lows, 25-year lows. There's fewer houses for sale today than there was in 2003. And the population is double what it was in 2003. However, with this latest increase in June, we are seeing that the supply has started to ramp up a little bit. Whether that's a trend or not, it's so difficult. People ask me this every day to read the tea leaves. And again, we have a potential further interest rate increase tomorrow. They have their meeting tomorrow, July the 12th. So they may increase it another quarter point, or they may not. Nobody really knows. But yes.
What else would you like to know from this side of the border?
Well, I'm rambling on here. I'm doing all the talking here, Adam. I better shut up and let you do the talking, but that's sort of the situation. And it's two different countries, but we're in the same boat. We really are. I think these are global issues. The low interest rates were there well before the pandemic. The pandemic was worldwide. All the trends you're seeing, like working from home, which I think is not going to last. I personally think that if you're a large corporation and you have an office tower downtown, how on earth can you enforce corporate culture if your staff are working from home? How can you get that corporate culture, get them to buy into it? If everybody's working from home, or if they come in 1 day a week or 2 days a week, you cannot get them to buy into that. And at that point, they're just a contract worker. They're doing the job, you're paying them, but there's no loyalty there. That's my personal view. I used to work for a big company, a big US company, before I got into real estate, and they were the absolute master at getting people to buy in to that corporate culture where you felt we are something special here, working at this company. And I still think about it today, 30 years later, 25 years later. Man, they knew what they were doing. Only the Americans know how to do that. They're just awesome.
Well, what we see is that in terms of the office market, like you say, there's pockets of variance, obviously, across the averages, but there are definitely two distinct worlds when it comes to office. We have clients who own large parts of downtown LA, and then we have others who own large office portfolios in Florida. And LA has been hit especially badly. But Florida is hitting 95+% occupancy rates.
Wow.
People are renewing smaller leases, but higher rents, and more people moving into Florida. So there's a lot of influx in Florida. It's two completely different worlds when it comes to office. And one of the key drivers of the office market nationwide that is consistent nationwide is the availability of amenities. If you've got an older B or C office building that just has, a bit of parking and corridors to offices, those buildings are really suffering. It's the ones that are replete with amenities like restaurants and play areas and community areas and outdoor areas and balconies and gyms and what audio video rooms, anything that has modern amenities. Those are the ones that are drawing tenants back.
Interesting. Very interesting. I can tell you, I believe this is correct. I know Toronto's always had a strong office, a very low vacancy rate with their office towers. I believe 5 years ago it was like 3%. It was tiny. It was very strong. Today, I just read in the paper maybe a week ago, it's up to 18% vacancy rate. So that's a huge jump. They're still building some towers, but I think that's about it for this cycle. I don't think you're going to see much more after that. So, but that's a very interesting thing that people are looking for, that all the bells and whistles. Do you think that's a millennial thing, or do you think that's just
no? I just think that it's the way that look, if you're competing with somebody who is working from home, at home you have the comforts of home, right? You've got a lot of conveniences, and the other big factor is commute. People don't want to commute as much as they did. So you really have to be able to entice them. Now, the counter point to that is the tenants, like those that provide good amenities, restaurants and other services that you might see in an office building, are reluctant to come back until they see tenants or occupancy increase, because they don't want to commit to a long lease if they think that there aren't the people who are going to, from the building itself, that's going to service the building. Now, I will tell you something interesting. So one of our clients told us that one of their buildings lost during the pandemic, and subsequently has not recovered, lost over $2 million to the bottom line, right? Straight to the bottom line strictly from parking revenues. So if you think about I don't know what it's like in Toronto, but in most of the MSAs in the States, if you go to an office building, you are going to park in the building and they're going to charge, for $20, $30 an hour. And you might get validation, right, from whoever it is that you're visiting. But even though that is paid for by the tenant. So the tenant is paying the landlord to be able to hand these out for free. So basically the landlord is getting the parking revenues. So what happened during the pandemic and is yet to recover is that, first of all, tenants started to vacate their premises. So that reduced parking use. Visitors stopped going to the offices because they weren't actively being used. So now you have these huge parking structures that were generating cash straight to the bottom line from revenues for parking that are now largely vacant. And that's another factor that has impacted office profitability, especially in some of the major MSAs where they have parking.
Interesting. Very interesting. So it's sort of a chain reaction in some ways.
Yeah, exactly. And then you also have the impact of reduced taxes, and there's just a lot of impact. It's a major shift.
Restaurants in the area, they've only got half the people coming through that they did before because there's only a trickle of people coming in. Yeah, no, I hear that. I hear that all the time. And yet, let's talk about restaurants. There are pockets like there's Mississauga is where I am. It's a suburb of Toronto. It's on the western end, and it's a very diverse kind of place. People from all around the world. We went on Friday night. We went for Chinese food. There's a plaza, a large plaza with a large parking lot, and there's about 30 different Chinese restaurants there. Mandarin, Cantonese, there's dim sum places, there's Mongolian barbecue, Korean places, there's everything. Japanese, there's sushi places. It's all Asian, and there's got to be 30 restaurants there. We went Friday night. Massive parking lot, was packed. It was full. Every restaurant, we didn't have a reservation. Everything was packed and full. I thought to myself and to the lady that was with me, this doesn't look like a recession. This doesn't look like a downturn. It's a Friday night in July in the suburbs. Maybe the economy's better than we think. because there's so much doom. I'm kind of shifting gears here, but there's so much
Mm.
doom and gloom that, especially if you read in the newspaper, recession is expected, the interest rates are going to cause all this trouble, and yet I go to this place with 30 restaurants, they're all packed in July, which normally people might be doing something
Well,
else.
but this is the other factor, is that although we are seeing some hospitality distress, uh, dis despite that and these pockets of hospitality distress, what we're also seeing is and it's unusual, because during a downturn, hospitality is one of the things that typically
First to go.
suffers the worst, and and is one of the first to go. But there's a lot of, like you say, there's a lot of cash. People have, even though they don't feel as wealthy as they did, they're not moving. They do have savings. There's a lot of money in the economy that was introduced through the various stimuli during the pandemic, and people are traveling. It's kind of it's like a reaction to having been stuck at home for a couple of years. Now people are traveling, so hospitality and entertainment are still robust, and in part this is surely what the Fed in the States is seeing, is just this hot. Plus, you've also got almost full employment. There's very little impact on unemployment.
There
So
you go.
people still have money in their pockets. They're still traveling. They're still eating out. They're still looking for entertainment. Even if they're not moving homes, the economy, particularly in the US, is still very, very strong.
I'm telling you, man, it's a weird time that we're living through.
Mm.
And you hear some people you talk to are very bearish. I'm not in that camp, although there's some risk, I think. I think there's definite risk in right now with various asset classes. But yeah, like you said, it's absolutely right. I know people have gone on like 3 or 4 trips already this year. It's like, you're right. They were locked up for 2 years with COVID, and now they're just gone ballistic. So it's all going on. And labor shortages here in my area, in the Greater Toronto area, there are huge shortages of labor, not just for low paying jobs, but for good jobs, for high paying jobs, technical, IT workers, stuff like that. They can't find enough people.
So, Randy, let me ask you, what do you think your audience would like to know about the what I'm doing, or what else
Okay.
is going on, or what
Let
opportunities?
All right. Let's talk about opportunities. I was
Yeah,
doing
go on. So, what do you think?
I
What do you think your audience would like to know? I mean, I just finished
okay.
writing a book. We could talk about that. Whatever you want.
I'd love to talk about that. Here's one question for you that might okay, so there's a lot of people in Canada that are looking to invest in the US. They're looking around. There's different possibilities there. If someone were to call you up or call one of your staff up and say, "Look, we're from Canada, we're from Vancouver, we'd like to buy some kind of commercial enterprise." Obviously, there's different things in Southern California. What would you tell them? What would you tell them as a very first step of what they should do or shouldn't do?
So the best thing that you can do. Look, and I'm not an investment advisor, all right? Just to be clear on
Oh,
that.
come
The
on now.
best
Sure.
option.
Yeah.
The best option is the changes in the regulations here that allow for online syndication. And this happened some years ago, or over 10 years ago. You now have the opportunity to invest in commercial real estate deals that you would never have had the opportunity to do before. So instead of looking for small commercial properties that are going to be difficult to manage long distance, you're better off looking at seasoned sponsors who are raising capital to acquire or refinance major commercial properties through what is colloquially called crowdfunding. So some of the asset classes that are particularly interesting, particularly today, are distressed real estate. So typically you're not going to have access to discounted distressed real estate. And even if you did, working through the problems that distress has is very, very complicated, time consuming, requires experience, and often requires considerable investment that you might not anticipate going in, especially if you don't have experience of dealing with it. There's various ways you can do that. You can either buy a building that has direct, you can invest in a building that itself is directly distressed, or you can acquire the loan. It's called the notes. You can buy the
Sure.
loan from a bank,
Sure.
and
You assume the loan. Right.
some of our banking friends are already beginning to sell notes. So you can buy notes, in which case you would step into the shoes of the lender, but you don't have direct access in those cases, of course, to the real estate. But there are a lot of seasoned professionals who understand the world of distressed real estate and who you can invest with. So rather than investing with an individual in an individual deal and trying to find something, it's like finding a needle in a haystack. You can find sponsors, multiple sponsors across the country who are finding distressed opportunities and invest a small amount with each of them. So the first thing that you want to do if you're going to do that is you've got to assess the sponsor, make sure that they are seasoned, experienced, know what they're doing, and credible. So that means that in all likelihood, they need to have been through this before, which means that their shop needs to have been around at least before the global financial crisis of 2007 and on.
Right.
That's the first thing that you want to look for. Once you find somebody that has that kind of experience and track record, then you can take a look at the deals that they're offering. And in many cases, they'll either, or there are two ways that they will offer opportunities to individual investors. One is in individual deals. So they will offer an individual, they will make available individual investment opportunities to individuals or to investors that you can invest in directly as a limited partner, or they might put together a fund. And with a fund, you have the benefits of diversification. The challenge with the fund, of course, though, is that you don't know going in exactly what deals they're going to be investing in. They will give you an investment thesis and tell you the kinds of deals that they'll be looking for in the fund, but they expect you to make a commitment before you know exactly what deals are in the fund. And that's why it's important to first get to know who the sponsor is, get comfortable with the sponsor, and then make an investment. And the nice thing about doing it that way is that if you've got 100,000 or 200, 500,000 or $1 million, you can spread your risk across a range of asset types, asset classes. So office, multifamily, self-storage, data centers, medical office, you name it. I mean, we deal with every single asset class. So first of all, you can diversify across asset class. Secondly, you can diversify across sponsors. So you can invest with multiple sponsors. And the third thing is you can invest across a range of geographical locations. So you can really get a pretty good exposure with mitigated downside risk investing in distressed real estate if you invest a relatively small amount with seasoned sponsors across a range of investment opportunities.
Okay.
So that's what I would recommend. And that is actually exactly what my new book is about. I don't actually have a copy. It's just an ebook at the moment.
Okay.
But I will be publishing.
Adam, what's the name of the book?
It's called The Reality of Distressed Real Estate.
Okay. By Adam Gower.
Yeah. It's you can actually find it on my website at gowercrowd.com. It's on the homepage. It's a $7 book. If you're not happy with it, I'll give you $7 back. But it's very detailed, and it's based on my 30 plus years of experience. Plus, also, Randy, I've been through these downturns, two major downturns throughout my career. The first one was in the early 90s, and that was actually when I lost all the wealth that I thought I'd built up in the 80s.
That was just before my time, but I had bought it. There was a big crash here in 1989. So similar. I think the US, Canada, the same that time. And we bought our first house in 91 because we thought, oh, well, it's coming back. But it took till 1996 for house prices to get back to where they were in that. Yeah.
And then the second downturn that I had experience of very much so was the global financial crisis that started in 2007. And at that time, I was hired I fortunately sold out my portfolio in 2007. So I had no legacy problems. And and I had dry powder, but I was brought into a major bank to help them clean their balance sheet. And so my job at that time was to look at all the loans, the real estate collateralized loans that were no longer performing. In other words, the borrowers had stopped paying on them, and were to sell those loans to investors. So I saw every possible way that real estate can go bad across every single asset class, and how people made huge fortunes buying those deals. But it is high risk and it's a very sophisticated play, because when somebody stops paying on their mortgage for a commercial real estate property, they will start cutting costs everywhere. And once you get into the deal and you start looking around, plus you also have very limited access to an asset when it's distressed before you actually buy. So you got to price that into your underwriting. It's inevitable that you start to find problems that were not necessarily apparent, like deferred maintenance or who knows what might be hidden underneath the hood that you just don't expect. Right. Plus, there's a higher chance of litigation because if you're stepping into the shoes of a lender, you never know. The borrower might choose to declare bankruptcy or play all kinds of games to prevent you from getting access to the real estate. So you've really got to know what you're doing when you're playing the distressed world. But that is exactly what the book Reality is all about. Again, you can, if you don't mind me plugging again, you can find it.
Go right ahead. And I am definitely going to put a link to your website underneath the YouTube video and also on the podcast as well. Absolutely.
Lovely. Yeah. Well, thank you very much, Randy. I really appreciate you having me.
It's a pleasure, Adam. Yeah, I'm glad we finally got to meet, and you're welcome to come back on the podcast anytime.
Well, thanks for having me, Randy.